The greatest threat to your portfolio may not be a recession, a market crash, or a bad company. It may be the person in the mirror. Your mind can turn luck into confidence, a falling stock into a trap, and a recent headline into a forecast. In this lecture, we expose the hidden biases steering investor decisions and the disciplines that can stop them from becoming expensive mistakes. We are going to study the foundations of behavioral finance. Our goal is simple: to understand why investors sometimes make decisions that look different from the decisions predicted by traditional finance. Traditional finance gives us a disciplined benchmark. It assumes that investors have stable preferences, use information carefully, update beliefs when new evidence arrives, and choose portfolios by comparing expected return and risk. This benchmark is extremely useful. It helps us think clearly about asset pricing, portfolio construction, and performance evaluation. Behavioral finance asks a complementary question: how do investors actually make decisions when they face uncertainty, emotions, limited attention, social pressure, and costly information? This doesn't mean investors are irrational all the time. It means investors can make systematic errors. These errors aren't random, they often follow patterns. So, throughout this lecture, think of traditional finance as the standard of what an investor should consider, and behavioral finance as the study of how real investors may depart from that standard. By the end, you should be able to identify major investor biases, explain how they affect risk perception and return expectations, and understand how a disciplined investment process can reduce their influence. Let's begin with the rational investor benchmark. In a traditional model, investors compare risky alternatives by looking at future outcomes. The idea is that an investor chooses the alternative that provides the best balance between expected benefit and risk. A rational investor isn't supposed to focus only on excitement, fear, past purchase price, or recent headlines. The decision should be based on forward-looking analysis. In this framework, risk matters. An investor is willing to accept more risk only when the expected reward is high enough to justify that risk. This is the core trade-off behind much of portfolio theory. The rational investor benchmark also assumes that investors use relevant available information, update beliefs when new evidence appears, evaluate positions as part of a total portfolio, and consider taxes, fees, liquidity, diversification, and opportunity cost. This benchmark is valuable because it gives us a clean decision discipline. For investment professionals, this isn't just theory. A portfolio recommendation should be based on future expected return, risk, client constraints, diversification, taxes, fees, and liquidity needs. A recommendation becomes weaker when it depends mainly on a recent headline, a desire to avoid admitting a loss, or confidence that isn't supported by evidence. Now we move from the ideal benchmark to the real world. Bounded rationality means that decision makers may want to be rational, but they face limits. Investors have limited time, limited attention, incomplete information, emotional pressure, and a very complex environment. Financial markets are full of choices. Investors must think about securities, interest rates, inflation, business risk, taxes, liquidity needs, and changing economic conditions. Fully analyzing every possible choice is usually not realistic. Because of this, investors often use simplified decision rules. These shortcuts can be useful. A shortcut may save time, reduce complexity, and help an investor act when full optimization is impossible. But a shortcut becomes dangerous when it ignores important information or creates a predictable error. This is where we distinguish between heuristics and biases. A heuristic is a mental shortcut. A bias is a systematic tendency to make a particular kind of mistake. In investing, learning is especially difficult because feedback is noisy. A profitable trade doesn't always mean the process was good. An unprofitable trade doesn't always mean the process was bad. That is why behavioral finance is so important. It helps us understand why reasonable people, facing uncertainty and pressure, may repeatedly make decisions that move them away from a well-supported investment choice. Biases can enter the investment decision process at many points. They can affect what information we notice, how we interpret that information, how we perceive risk, what return we expect, how often we trade, and whether our portfolio is truly diversified. A central example is overconfidence. Overconfidence is the tendency to place too much faith in our own knowledge, forecasts, or ability to control outcomes. In finance, this can appear in several ways. An investor may believe their skill is higher than it really is. They may express forecasts with too much precision. They may think they are better than most other investors. Or they may believe that effort, attention, and trading activity give them control over outcomes that remain highly uncertain. The problem isn't only the model. The problem is also the confidence we place in the numbers we put into the model. Overconfidence can lead to excessive trading, under-diversification, weak attention to downside risk, and reluctance to use benchmarks or outside views. It can also cause investors to confuse luck with skill. A strong investment process treats confidence as a claim that must be tested. Forecasts should be compared with base rates, scenarios, valuation ranges, benchmarks, and the investor's own decision record. Next, let's discuss loss aversion. Loss aversion means that losses tend to feel more painful than comparable gains feel pleasant. Investors often evaluate outcomes relative to a reference point, such as a purchase price, a previous portfolio high, a target wealth level, or an expected result. The visual behind me shows a common way to represent this idea. The important intuition is that investors may react differently to gains and losses, even when the economic decision should be based on future risk and future return. Loss aversion can lead to several investment behaviors. Investors may sell winning positions quickly because they want to lock in the feeling of success. They may hold losing positions too long because realizing the loss feels emotionally difficult. They may take additional risk in an attempt to break even. They may avoid useful rebalancing because it requires selling a familiar holding. They may also become overly cautious after a painful market decline. The key question isn't whether an investment is currently showing a gain or a loss. The key question is forward-looking. Given today's price, today's risk, taxes, alternatives, and portfolio needs, would the investor choose to own this position now? For advisors and portfolio managers, this matters deeply. A rational recommendation may feel emotionally uncomfortable to a client. Good communication connects the recommendation to future risk, opportunity cost, taxes, liquidity, and the investor's stated objectives. Anchoring occurs when an investor relies too heavily on an initial reference point, even when that reference point is no longer economically relevant. Common anchors include purchase price, a previous high, a target price, a recent market level, or a valuation multiple from a different market environment. Anchoring becomes a bias when the investor adjusts away from the reference point too slowly. For example, an investor may refuse to sell until a position returns to the original purchase price. But the purchase price isn't a valuation argument. It may matter for taxes and performance measurement, but it doesn't determine intrinsic value. A practical safeguard is to restate the decision without the anchor. Instead of asking when a position will return to a past level, ask whether it is attractive today relative to its risk and alternatives. Now let's connect this to confirmation bias. Confirmation bias is the tendency to seek, interpret, and remember information that supports an existing belief, while discounting information that challenges it. This bias can make an investment process look analytical, even when it is one-sided. The investor may read reports, build models, and follow news carefully, but only in a way that protects the original conclusion. A disciplined process requires disconfirmation. Ask what evidence would prove the thesis wrong. Ask what the strongest opposing argument is. Ask whether confidence comes from independent evidence or repeated exposure to the same story. The goal isn't to be negative. The goal is to protect the decision process from becoming a search for agreement. Representativeness is the tendency to judge something by how closely it resembles a familiar pattern. In investing, This often appears when investors infer too much from recent performance. A fund with strong recent returns may be judged as a high-skill fund, even when the returns may reflect style exposure, market conditions, sector concentration, or luck. A company with an exciting product may be judged as a good investment, even if the stock price already reflects very optimistic expectations. This is a crucial distinction. A good company isn't always a good stock. The investment decision depends on price, expectations, risk, and alternatives. Representativeness can lead investors to chase trends, ignore base rates, underestimate luck, and classify a new opportunity by superficial resemblance to a past winner. The antidote is to use comparison groups and base rates. Ask how often similar firms have converted growth into durable cash flows. Ask how much success is already priced in. Ask what downside scenarios could challenge the story. Availability bias is closely related. It occurs when investors judge importance or probability by how easily examples come to mind. Recent, vivid, emotional, and heavily publicized events receive too much weight. After a severe decline, risk may feel larger than the long-term evidence suggests. After intense positive media attention, investors may underestimate valuation risk and competition. A useful question is, would I view this risk the same way if it had not been in the news recently? Mental accounting is the tendency to separate money into different psychological accounts. Mental accounts can be useful because they help people organize complex financial decisions, but they can also create problems when investors ignore the economic connections among accounts. For example, an investor may treat dividend income differently from selling a small part of a position for the same cash need. Another investor may take high risk in a speculative account while holding too much cash in a safe account. Someone may evaluate each position by its own gain or loss instead of asking how it contributes to total portfolio risk. From a portfolio perspective, total wealth and total risk exposure are what matter. A portfolio can appear conservative in one account and aggressive in another, but the correct evaluation depends on the combined allocation, correlations, liquidity needs, tax situation, and investment horizon. Mental accounting also interacts with loss aversion. A losing position may sit in its own psychological account, making it difficult to close the account and realize the loss. Now, consider framing effects. Framing effects occur when equivalent choices lead to different decisions because they are presented differently. A choice can be framed as income, protection, speculation, insurance, loss avoidance, or regret avoidance. The economic substance may be the same, but the psychological response changes. A disciplined process reframes the decision in terms of cash flows, risk, return, taxes, liquidity, and opportunity cost. The disposition effect is the tendency to sell winning investments too early and hold losing investments too long. This behavior can arise from loss aversion, regret avoidance, anchoring, mental accounting, and the desire to break even. The central idea is simple. Investors may be more willing to realize gains than to realize losses. This can harm portfolios in several ways. Winners may be sold before the investment thesis has fully played out. Losers may remain in the portfolio even when their forward-looking prospects are weak. The portfolio may become concentrated in positions with poor expected performance. Useful tax loss opportunities may be missed. Risk may be evaluated relative to purchase price instead of current value and future uncertainty. But we should be careful. Not every sale of a winner is biased. Selling a winner can be rational when valuation becomes unattractive, risk becomes too concentrated, or liquidity is needed. Holding a loser can also be rational when expected return is attractive after the price decline. The behavioral concern is the reason for the decision. Now connect this to excess trading and performance chasing. Trading isn't automatically irrational. Rebalancing, risk management, tax planning, liquidity needs, and new information can justify trades. The concern is trading when the expected benefit is too small to justify costs, taxes, spreads, fees, and decision risk. Past performance is evidence to analyze, not a decision rule by itself. Let's finish with a behavioral audit and a set of decision disciplines. A behavioral audit asks us to restate each investment decision in forward-looking terms. Don't ask only whether a position has gone up or down. Ask what expected return and risk look like from today's price. Ask what role the position plays in the total portfolio. Ask whether it improves diversification or duplicates risks already present. Ask about taxes, fees, liquidity, and opportunity cost. Ask whether the investor would buy the same position today if it weren't already in the portfolio. Behavioral finance doesn't automatically tell us to sell the winner, hold the loser, avoid the popular sector, or stop trading. It asks whether the action is justified by current evidence rather than by emotional labels attached to past gains and losses. Biases cannot be removed completely, but investment processes can reduce their influence. Write the investment thesis before entering a position. Identify what evidence would change the decision. Use base rates and comparison groups. Separate the decision to own an asset today from the desire to recover a past loss. Evaluate risk at the total portfolio level. Use rebalancing rules. Require a disconfirming argument before adding to a position. Track forecasts and decisions over time. Consider taxes, trading costs, fees, and liquidity before acting. These disciplines slow us down when intuition is most likely to dominate.